Welcome to the 3 Edge Week in Review for the week of February 20th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here today, once again, is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing the debate among investors about whether the U.S. economy might experience either a soft landing or a hard landing as a result of the Fed's monetary tightening. And in particular, we'll take a look at how here early in 23, there seems to have been no landing, or at least no landing yet for the U.S. economy, and that may not necessarily be a good thing in the long run. Before we get into today's topic, we take a quick look at this week's activity in the global capital markets. And perhaps the biggest news for the markets came yesterday when the Bureau of Economic Analysis released its report on the Personal Income Price Expenditures Index, the PCE, for January. The PCE is the Fed's preferred measure of inflation, and so it wasn't good news for the Fed or the markets really when the report indicated that the index increased by 0.6% from December to January. And even excluding food and energy, the core PCE price index also climbed 0.6%, and this was the largest month-over-month increase since June of last year. News sent the equity markets into a decline, and in the bond market, the yield on the 2-year Treasury rose to its highest level since 2007. And so now investors face the prospect that the Fed will need to keep interest rates higher for longer, which could be a threat for those investors hoping for a soft landing. So let's get started. Let me bring Steve into our conversation. So Steve, based on, we had some pretty aggressive monetary tightening by the Fed in 2022. I think it was the most significant and fastest increase in short-term rates maybe in 40 years. And, so the consensus was that the U.S. economy was headed for a slowdown, maybe even a recession. And investors, as we know, have been arguing for a long time now, okay, would we experience a soft landing or a hard landing? And yet, so far, there's really been no landing, right? I mean, we're seeing consumers are continuing to spend, the labor market remains tight, and, maybe corporate profits have peaked, but they're resilient, as is the U.S. economy. And maybe all of this isn't so good in the end. So maybe you could just level set for us here and say, well, where are we? Are we on our way to hard landing, soft landing, no landing? Maybe just that would be very helpful, I think.
Well, you're right, Fritz. There's been this big debate going on whether it was going to be a very weak recession or a stronger recession. And so far, it appears there's been no recession. All the data that's come out recently has shown that unemployment is still near all-time record lows. Inflation is still running hot. We have retail sales that are stronger than people expected. GDP, the last GDP report was stronger. So there's a narrative that's been growing in the financial community that says perhaps everyone was wrong. There's no landing, as you say. There's no recession. And we're off to the races again. It's a new bull market. Jump on board before you miss out. And we've seen quite a rally up until very recently. And that's been a narrative that's taken over a lot of the market. We don't subscribe to that narrative. And we think that the problem is that, many of these investors thought, well, we dodged a bullet. I don't think we've seen the bullet yet. Now, for perspective, I want to pull up a chart. And we've referred to this in the past, and I know we'll refer to this in the future. And it's called our Seasons of the Market chart. And it helps give a perspective, sometimes a bit overly simplistic, but gives a perspective on where we might be in the normal market cycle. The market cycles through different phases. And we draw an analogy between the different phases of a market cycle and the seasons: winter, spring, summer, and fall. And we think of winter as the recession, spring is the recovery. Summer is when the recovery goes too far and the economy overheats. Fall is when the Fed comes in to try to cool everything down. And we've seen over the years, the market just go through these different phases. And at each phase, a different asset class either outperforms or underperforms. And it presents a nice, simple overview as to one way to think of asset allocation. So describing what the popular narrative has been, it's as though We had an overheated economy in 2021 into 2022. The Fed came in and, as you said, raised interest rates. So we moved from summer to fall. The narrative was that the Fed is nearly done raising interest rates and before the end of the year would actually drop them. That would move from fall to winter, that winter was going to be very, very mild, and people were investing in anticipation of spring or the recovery. And that's been a lot of the action that we've seen over the last few weeks. However, the new data shows that perhaps that's a very premature way of thinking of it, that we still see signs of inflation. And as you mentioned, just on Friday, we saw a much higher report than expected and certainly than hoped by the Fed. And we've seen signs of the economy still running hot with record unemployment, et cetera. And so perhaps we're still in that period between summer and fall. The Fed is a long way from being done tightening. And we haven't even gone through the worst part of the fall, never mind winter. So while there's been no landing yet, it could just be a premature view that we already passed the worst part. And in reality, we haven't even got to the worst part yet.
Right. Okay. So then what are the implications then for markets if we're stuck in fall, as you said, currently?
So it could be that, as we've said before, this rally that we've been seeing is an echo bubble or a bear market rally. It's a rally of hope that all the bad news is out of the way and that we're off to the races in a new bull market. And there are a lot of very respected financial analysts who have been talking about that and broadcasting that. But we think that that's overly complacent and not sufficiently prudent and cautious, because we think that with inflation having come down from 9% down to the 6% range, it's now appearing to be sticky. We're a long way from 2%. The Federal Reserve Board was hoping its job would be easy, that inflation would keep coming down at a steep rate all the way down to 2%. And then it could declare victory. It wouldn't have to keep raising rates. The economy perhaps would avoid a recession and everything would be easy. Well, it didn't turn out that way. It seems that inflation is stickier. There are reasons why it's stickier. It's not just food and energy. It's core inflation. Wages have been rising, and those can be stickier. And so the Fed is going to have a much tougher job going forward. If they carry out their promise and they do continue to raise rates until inflation comes back to 2%, could be a lot higher and for longer than the markets have been expecting or pricing in. That would not be good news for the markets.
So, all right, as always, final question is based on what we've talked about here today, potential for no landing, or, the idea that at least no landing yet, that narrative, which could mean inflation higher for longer, Fed still has a lot of work to do, et cetera. How should an investor consider thinking about their portfolio in this current environment?
So we think the prudent approach, based on all of our analysis and based on what we see going on with inflation recently, we think the prudent approach would be to not fall into the temptation to throw caution to the wind and put all your money back in the stock market. We think U.S. stock market's still overvalued. We think that inflation is stickier. The Fed's going to have to fight inflation more stringently. And so we think people should still stay cautious with their equities. Now, we think the most overvalued equities globally are the U.S. large growth, large cap companies like the S&P 500 type companies. So we would be, at a minimum part of a range of allocation there. There are some equities internationally that are not so overvalued and in some cases are undervalued. And so if you were to have a modest equity allocation overall, perhaps favor those more than the U.S. But if the U.S. does take a big hit, there's even a concern that it could drag down the rest of the world, at least temporarily. Now, if the Fed doesn't continue its fight against inflation or decides it's gone far enough and it doesn't want to continue, and inflation then remains elevated for a longer period, then in that case, it would be dangerous to have long-term bonds because they'd be vulnerable to continued rise in interest rates. But it'd be more advantageous to have TIPS, Treasury Inflation Protected Securities. and maybe even hard assets like gold.
Mm-hmm.
Now, in the short term, when the Fed threatens to raise rates, that could be a headwind for gold and hard assets. But longer term, at some point when the Fed stops its hikes, then gold could really take off because real rates would start to come down again. So we would favor non-U.S. stocks over U.S. stocks, but generally speaking, be cautious about equities overall. We would favor real assets over regular bonds or regular fixed income. And we'd include tips along with real assets as more favorable. But again, to be a little bit cautious in the short term if the Fed really starts to ramp up interest rate hikes again. And we think it's good to have some dry powder, some very short-term treasuries and cash-like equivalents to take advantage of potentially lower prices in the future.
Excellent. Great. Thank you. Thanks for your insight. I know this is a topic that we discuss a lot in investment committee, in conjunction with our model research. And actually getting ready for today's video, I realized that, we really are able in these weekly videos to provide clients with a look into the topics that we actually discuss in investment committee. And I think that's a good thing. We're providing, a level of transparency to our clients, keeping them informed about our current thinking. So thank you very much for your insight there. So next week, we'll actually be turning the calendar into March, which means that Eric Beagleisen and I will be providing our monthly view from the edge for March. We dive into our outlook for the markets based on our model research and discuss any changes to our outlook that have occurred over the course of the last month. So that will do it for Steve and me for this week. Remember, all our videos are available on our 3Edge YouTube channel. In addition, all our videos and all of our written comments are always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.